Chapter 1: Bonds. Stocks and bonds are traditionally used as complementing asset classes, as they have such different characteristics, payouts, and risk profiles. But that common knowledge is only a half-truth, and in today's environment of low yields and extraordinary monetary policy, it is wise to go back to the basics and take a look at bonds objectively. What are bonds? To get a grasp of the benefits and risks of bonds to your portfolio, you have to know that they are basically standardized credit agreements. If you buy a bond from its issuer, the primary market, you lend it money with the conditions predetermined by the bond. Also, if you buy a bond from its current holder on the secondary market, you will get all the proceeds from the issuer. The issuer of a bond can be a lot of different types of entities. Most prominently, governments, sovereign bonds, corporations or municipalities like states, cities, or regions issue bonds. The issuer will be the biggest factor in valuing a bond. Why? Whatever the conditions, such as interest, price, maturity, you will have to determine the capability of the issuer to repay its debt. This leads to the second part of the chapter, and it sheds light on a common misunderstanding about bonds. Are bonds risky? The common knowledge about bonds is that they are then stocks. The low inflation and interest rate environment currently reinforces this concept. The problem is that this is not always true. Even with moderate inflation and rising interest rates, bonds can get really risky. And with high inflation, they can get disastrous compared to stocks. And I haven't said a word about credit risk, the risk of the issuer failing to meet its obligations. And that happens all the time, even with countries. Just recently Greece, maybe soon Venezuela, and the Ukraine, to name a few. And presumably safe companies, choosing between the stock and the bond of a company. As we have analyzed stocks before, I will start with corporate bonds, as they are the closest to each other. If you know that a company is strong and you would buy its stock, it should be certain that its bonds are safe investments. But there is the possibility that you wouldn't touch a stock, but the bonds of the company are attractive. How? Let's see an example.